Okay, looks like I'm live. It's great to be here. Thank you, Catherine. I'm Dave Mondragon, and I am a Vice President of Enterprise Product Development at IHS Markit. I've been in the industry for about 35 years. I spent 32 years at Ford Motor Company before I came to IHS in sales and marketing. So I have a great tenure in the US and in Canada serving the dealers and serving the industry. IHS Markit has a plethora of data. We're really a huge data aggregation and insight company. We track 125 million households in the US. We have 650 million vehicles in our database. We have ownership records of 3.4 billion customers in terms of the history of data we have. We own Carfax and Polk and Mastermind as well. And with that, we get about 25 years of Carfax data, which gives us a lot of insight in terms of serviceability of vehicle and future valuations of vehicle, as well as predictive maintenance behavior of vehicles. And we also have relationships with 60,000 aftermarket dealers. So that's just a little bit of the background, and some of the data that I'll be sharing comes from the aggregation of those resources. The industry is really at a pivotal point, and what I want to talk about today, I've got about 15 minutes, and I want to kind of frame this up in terms of discussion. I want to talk mostly about change. We've got great speakers over the next 2 days. They're going to cover the full spectrum of commercial sales and trends. And I want to kick off the meeting with some mental bookends. First, I want to go through the industry forecast. Then I want to go through the production mix. I want to talk about commercial implications, and then electrification and new business opportunities. So I'm going to try to cram that into the next 13 and a half minutes and see what I can do to frame this up. So as we start to look at the light vehicle sales outlook, we experienced a very healthy COVID dip in 2020, as you're all aware of that. So we went from 17 million industry down to 14.6. The industry will actually leap back very, very strongly in 2021 and hold fairly steady in the 16 to 16.5 million range through the end of the decade. And you know, this is important. Anything in the industry in the US that starts with a 16 million is a great sign. And that gives plenty of opportunity for manufacturers to invest in new product, and then for our retailers to be able to have a very robust footprint as we go forward. The fleet sales forecast is interesting because you can see it's fairly consistent across the board for commercial and government. Those are two components. The third component, which is obviously the largest in fleet, is rental. And you can see rental took a fairly healthy hit during the downturn. So this was a big impact. They're going to claw it back over the next 5 years, and then they'll get to the normalized run rate of about 11 to 12% of total sales in the industry. We'll go back to rental. And rental is very important for the industry because it allows manufacturers to get better economies of scales. They can fill the production pipeline. They can help support the supply base with more sales and more potential revenue, but it brings down the cost of vehicles as they go to market and gives them better efficiency at the plant. So rental business is very important. Now, this business also is only reflective of fleets with 10 or more. So it's not the small mom and pop fleets that might buy 2 or 3 units. It's just a bigger picture. Those actually, in terms of volume, won't influence the overall mix that much. The production outlook is pretty consistent with sales. It's about 16.5 million over the next 8 years. And as you can see, you know, is a deep COVID-related cut for 2020, but a much quicker snapback than the Great Recession. So as you remember that back in 2008, it was a very elongated glide path to get back to where we're at now in terms of the normal production rate. This is going to be a quick snapback, and then we'll hold in the 16.5 million range for production in North America. Obviously, this is North American production, so it doesn't include production that will come from outside of North America. Europe, mostly for a lot of the luxury brands, luxury Europeans, they're going to bring in a lot of vehicles from outside the country. As far as EV, this is important because you're going to have a lot of people over the next 2 days talking about EV, and it does have a strong influence in the market. EV, North America production forecast, as you see on the screen. First off, again, this does not include imported vehicles from outside North America. It's North America production, but 2 key points on the EV production for you to note is, first, you can see the annual percentage growth on a percentage basis is huge. You know, we went from 250,000 in 2020 to 440. You can see production in 2021. So somebody will say, well, that's a almost 100% growth rate in terms of the production, and they grow at these fairly healthy clips as we go far as a percent basis. But you can see the raw volume is a stair-step approach, and we'll stair-step our volume to electrification. So the raw volumes are nowhere near as huge as the percent growth that you'll see. EV production, though, does grow from 3% to 16% over this decade. We're at 3% last year. We go to 16%. And I think equally interesting to note is ICE engines, internal combustion engines, will decline from 91% of production in 2020 to 59% by the end of the decade. So a big decline. Again, this is interesting in total. Now let's take a look at the reflection in the fleet business, though. As we look at fleet, and again, I'm going to park government. Government will actually over-index in electrification. I will park rental because they'll probably participate equally to the retail environment in the marketplace. And then I'm going to just focus here on commercial fleet. This is class 1 through 7 light duty and medium trucks, excluding class 8 big rigs. If you can see that the electrification does have a pretty gradual growth in terms of production and sales over the rest of this decade. It gets up to 2028, about 10% of the mix, but it starts very slow. You can see the predominant vehicle of choice in the marketplace from a production and sales point for a commercial marketplace in the US will still remain gas and diesel. So the reason why this is important is because we have a lot of time to transition to electrification. You're seeing a lot of headlines in the news with brands saying they're going to shift 100% of their portfolio to electric over the next 10 to 15 years. The good part for the commercial side of the business is we have plenty of time to experience the productivity of these vehicles. There's a lot of infrastructure that has to get put in place, and then there's grid technology and grid capacity that has to be in place to support all this as we grow this footprint across the nation. So it'll be a mild transition, a lot of testing and learning from a lot of companies that you deal with. With regard to the EV transition, though, in the future, EV sales consultants will need to be much more conversant on the features and benefits of selling EVs. This may require, quite frankly, a different type of sales consultative approach, and also maybe a different type of sales consultant, more tech savvy, more business finance acclimated, because a lot of the discussions will not really be around GVD specifications and engine and transmission and wheelhouse combinations. A lot of the conversations will go to the value proposition and the productivity of the vehicle, and then also the trade-off in terms of expense structures, which we'll get into in a second. Service centers will not be as important for EVs. So again, that'll happen over time, but as we know, there's over 2,000 moving parts in an ICE vehicle. There's a little over 20 moving parts in an electric vehicle. So what this does is it allows startups like Tesla, Rivian, Workhorse, and others to jump into the marketplace quickly with a solution without having to concern themselves with service centers. However, established brands with both ICE and EV vehicles will have adoption time and a huge car park of vehicles on the road today to allow time for this transition. And this is really time from a financial standpoint and investment standpoint. So if you think about it, there's nearly 300 million internal combustion engine vehicles on the road in the US. That's a lot of vehicles. The average age of a vehicle today is 11.8 years old. So the car park is the largest it's ever been, and the age of the vehicles is the longest it's ever been. So as we look through selling 90% of the vehicles more than 90% over the next decade being gas and diesel, and then still maybe a more aggressive transition to electrification to 2030 and 40. So we will see that glide path accelerate. We're still going to be selling a high mix of gas and electric into that decade. So that just says there's time to transition. There's time to establish the footprint. And mostly for dealers, it's time to it's giving them the opportunity to have a very viable operation from a service, capacity, and sales standpoint as we transition to more electrification over time. Collision work does not go away with EVs, so there'll still be accidents out there, but competition will sprout as service centers start to transition. There's a lot of service centers, mom and pop centers and other service centers that will have to adopt collision work to be able to fight for survival over time as well. EV premium payback. Now, this is really an important part of the sales process as we go forward. If you look at the industry, when we first started talking about EV adoption, we looked at offsetting the cost of electrification through fuel savings only. That was the only lens we looked at. And actually, when fuel prices got up during the Great Recession to $5 a gallon, there was a little bit of joy in the electrification teams because we saw people drop off their keys and migrate quickly to electric vehicles because they wanted to get more mileage and more value out of that, but they couldn't afford the fuel prices. That was really, that singular focus created an unfair comparison against traditional ICE vehicles. Today, the industry is much more sophisticated, and we have data that will support the new level of sophistication and the new level of value props that we can propose to customers. Lower fuel costs is still a part of that, but also maintenance savings, driver productivity, vehicle productivity measured in uptime, and uptime will be the new currency as we go forward, and product life cycle. All of these factors will come into play when we look at offsetting the price and cost, the fuel of the electric powertrain. And these applications and this value proposition will be applicable to both retail and fleet customers. In suburban and urban delivery applications, medium-duty EVs, we've done a forecast at IHS that says in the future, we expect them to enjoy an operating cost of nearly 50% lower or below comparable diesel engines. So we see this value proposition continue to unfold over time, and the maintenance savings, dealer or driver productivity and vehicle productivity will be a huge contributor to offset the cost of the incremental electrification platform. EV adoption is interesting, and again, uptime will become a new currency. Range will be an issue for certain customers, but not all customers. For example, many van drivers, commercial van drivers that you know, drive less than 100 miles per day. They tend to have fixed and localized routes that can easily be accommodated with the current range estimates for commercial EVs. Many account managers, actually, many of your accounts will have route management systems. You're going to be able to simply plug in and download that information, and that'll help you determine the size and battery requirements. And understanding the life and cost of the vehicles will be very important as we go forward. Emerging revenue models. I'm down to my last minute, so I'm going to go quickly here. New software and digital services. This is huge for the industry, and it's huge for the dealers. Ford uses an example of the Peloton example. You sell the bike for $2,500, then they sell a subscription for $40 a month. You know, once you fast forward 64 months and you've paid the same amount as the bike, the hardware margins are much lower than the software margins, and the software margins are reoccurring over the life of the vehicle. So this creates a whole new revenue stream, and for a lot of dealers, this will create revenue stream that'll help offset some of that loss in service business. It'll definitely help offset that loss in service business for the OEM. So this is really an important avenue. And data analytics and telematics will be important as we go forward as well. Uplift revenue is important. It's not going away. And it will be a key differentiation for established brands. So this upfit business is a strong profit opportunity for the dealers and the OEMs, and then our third-party upfitters. It's important to note that those economies of scale, entrenched dealer relations, and current players, it will benefit from all of those relationships going forward. And it's harder for a new startup to have that. OEMs will share their vehicles up to a year in advance, if not 2 years in advance, with upfitters so that they can start to get the tooling in place, the bins and rack systems in place, so when they go to market, they've got a product that's viable and a product that the consumers can use to the highest level of ability. So just to sum it up, we're going to see extreme volatility in the short term in the industry. This chip component is real, but it's going to have ebb and flows. We've got some other factors stressing the market, but we still see consistency in the industry around 16 to 16.5 over the next decade. We see new revenue models will evolve, just as we talked about quickly on the software front. and then new valuation. Scale is going to be imperative. We'll see more partnerships going forward. Strategic collaboration does not have to mean mergers and acquisition. And I praise Ford and Google for the new partnership as they go forward. This is an excellent example of leveraging technology as we go forward, and it creates a new foundation for a company like Ford. It's not just building and manufacturing vehicles. It's going to open the opportunity for them to become a true software company, a software provider, and a SaaS company in the future with huge margin capabilities and potential for the company. The final thing, as I said before, we have time. The shift will be gradual. And the most important thing is those who adapt will not only survive, but thrive. So with that, thank you so much. I hope you have a great 2 days and so excited to hear the other speakers.